The world looks on in horror as Russia intensifies its attack on Ukraine. This is Bloomberg Wall Street Week. I'm David Weston. This week, special contributor Larry Summers on the Washington embargo on Russian oil.
This is the price of freedom. And so if higher prices of gasoline are the price of freedom, it is a price that this generation of Americans should pay.
And Sam Zell of Equity Group Investors on what war in Ukraine has made uninvestable.
For an investor, this is a level of uncertainty that we haven't had to deal with.
There was a lot that happened this week, but you could be forgiven if you found it hard to pay attention. There were the U.S. CPI numbers reinforcing concerns about inflation.
Economists have this right. The problem is, of course, this is all February data, and the war in Ukraine did not start until February 24th.
There was the ECB saying it may move up the time for ending its asset purchase program.
The support that net asset purchases can give to policy rates is getting close to a conclusion.
And there was a $1.5 trillion budget package that moved forward in Congress.
All in favor say aye. Opposed, no. The ayes have it. The bill is passed.
But let's be honest, all of us were paying most attention to what was going on in Ukraine and the enormous ripple effects all around the world. For the latest on this story that has truly gripped the entire world this week, we welcome now Bloomberg White House correspondent Josh Wingrove, coming from the White House. So, Josh, thanks for being with us. An awful lot happened, a lot of sanctions, a lot of developments on the ground over there. Summarize where we are at the end of the week from the White House's perspective.
Yeah, that's right, David. I mean, on the side of the war, we've seen over the week just a steady increase in artillery and bombing strikes that appear almost increasingly aimed at civilian centers, civilian buildings. That has led the White House to start talking more and more about either apparent or likely war crimes violations being committed. But on the sanctions side, in other words, what they're trying to do about it, I mean, just so much has changed. It just goes to show, David, about how quickly these facts keep moving in terms of what the West is doing in its sort of coordinated response. I mean, a week ago, we did not have the U.S. oil ban that has been imposed on both oil, but I should say also coal and other products. That was at the beginning of the week. Over the course of the week, we had discourse about Poland talking about fighter jets, U.S. pushing back on that. This continues to be a really live ball, David, about how and if the West can help Ukraine in particular by giving them planes somehow to use. And of course, some of the most recent and most significant measures came on Friday, today, as I speak here, about the most favored nation status. This is sort of in the weeds of trade rules, David, but you know Bloomberg thrives in the weeds, and it was a scoop from our colleague Jenny Leonard, who broke this, saying that what G7 and WTO nations are going to move forward to essentially allow themselves to lift tariffs overall on Russia and punish them. And the U.S. is going to go a step farther and say, look, we are going to have to block altogether certain shipments, including of seafood like caviar, Russian vodka, diamonds, that sort of thing. We also have new sanctions announced this week. So if you go, from the beginning of the week to the end of the week, starting with that oil development, which was a scoop also from our colleagues here at Bloomberg, Anne-Marie Horder and Jennifer Jacobs and Saleha Mohsen. You go all the way up. There's just been a steady ratcheting of economic pressure. Joe Biden on Friday predicting that the Russian stock market will collapse when it opens, if it ever opens. But of course, the question is, will it work? Will it give Putin an incentive to stop or at least reduce the hostilities?
That certainly is the big question. Thank you so much for that report from Bloomberg's Josh Wingrove. As we watch what's unfolding in Ukraine, it's the people and the devastation that matter the most. But it also has potentially profound effects on investors and economies all around the world. To explain some of the consequences we've seen so far, welcome now Afsaneh Beschloss. She's founder and CEO of RockCreek, and Steve Rattner, chairman and CEO of Willett Advisors, which invests the personal and philanthropic assets of Michael Bloomberg. He is, of course, the founder and majority owner of our parent company. Steve, let me start with with you. I believe you spent some of your career covering oil. You know oil. Afsaneh certainly does. Is what's going on in the oil and gas market one of the most immediate and most profound effects we're seeing so far of what's going on?
Certainly the most, one of the most visible, if not the most visible effect, obviously the run-up in oil prices. And you showed shots of gasoline prices going through the roof at the beginning of this, as Larry was speaking. And there is no question it's a major issue. Russia produces roughly 10% of the world's oil, exports roughly 5% of it. Oil was already in tight supply before the invasion, not a well-known fact necessarily. A lot of questions about how much excess production capacity OPEC really has. And so if Russian oil production is lost to the world, and I'm certainly not advocating being soft on the Russians, but if Russian oil is lost to the world, it could have a major, major impact on prices. But other commodities, wheat, corn, precious metals, all kinds of commodities have been soaring, again, both before the invasion, but even more so since it, because Russia and Ukraine are sources of a number of important minerals and metals and other components that we need to make things. And that gets into the famous supply chain problems we've been having.
And Afsaneh, from your point of view, is there enough oil to be brought in from the sidelines? Steve referred to perhaps excess capacity in OPEC. We also have things like Iran and Venezuela and maybe more production in the United States.
I think, as Steve has been saying all along, we can, in the longer term, increase the supply of energy, whether it's through LNG, new terminals being built, or through potentially an agreement with Iran and Venezuela to use some of the existing oil, particularly Iran has been stockpiling, I think. But those are all, particularly on the LNG story, it's a much longer term thing. And on Iran and Venezuela, politically, those may or may not happen. So we have the short-term problem, and then we have the long-term problem, David. On the long-term problem, I think the question is, if we wanted to look at just one little positive fact, whether Ukraine will be a turning point, and what climate conversations and COP26 could not do. Ukraine will lead, and energy security will lead US, Europe, and the rest of the developed world to start looking at energy self-sufficiency in a very different way.
And Steve, we're all focused on what this will do to Russia and its economy. There may well be some spring back into the United States and other Western economies as well. Supply chains are pretty intricate. You mentioned supply chains a moment ago. There's a lot of things that we may be getting from places like Russia we didn't know, or even Ukraine.
Sure. First of all, wars are generally not good for economies in the aftermath of wars. You typically get a lot of inflation. You typically get slower growth. You've got to repair war damage. It's obviously not a global war, but nonetheless, that's certainly the history of wars. But in terms of supplies, as I suggested a minute ago, Russia and Ukraine are the sources of a very important number of commodities. Neon gas, which we all think about as going into signs outside bars, is a critical ingredient for making semiconductors. And Russia and Ukraine supply a huge percentage of the world's neon gas. And you can go on from there through palladium and nickel and all kinds of other things that are necessary. And sure, over time, you can probably find other sources for most, if not all of these things. But as Afsaneh was saying in the context of energy, with which I completely agree with her, all this takes a lot of time and it comes at a cost. We are, as you sit here in a normal world, we're obviously sourcing the least expensive, easiest to find places to get all these kinds of things. If you lose a source of supply, you've got to find another place to get it from. And that all adds costs, it adds to inflation, and it retards economic growth in a potentially significant way.
Steve, pick up on that inflation point. We got the CPI numbers this week, as you know so well, 7.9% year over year. And as Larry pointed out already in this program, that's before you really get the full effects of this war. As an investor, what do you do in this world where you already had an inflation problem and it is all likely to become even worse? At the same time, the growth may be deterred. What do? Do you just get really conservative?
Yeah, look, the inflation problem is very worrisome to me, as it obviously has been to Larry for a long time. Inflation in and of itself isn't necessarily the worst thing for investments because the value of companies can go up as well. But the problem really is it puts a lot more pressure on the Fed. The Fed is already going to raise interest rates this week. There was some talk before Ukraine that it might do as much as 50 basis points to try to address the inflation problem. Jay Powell signaled in his testimony more likely to be 25 because of the concerns about growth. And that's fine to kind of keep the world or the US growing, but it doesn't address the inflation problem. And sooner or later, the chickens are going to come home to roost. I happen to have been, in addition to covering energy, I was a New York Times economics reporter in the 70s. I was at Paul Volcker's press conference in 1979 when he announced his whole new framework. I'm not suggesting we're going to go back to that, but this is the first time since then, certainly since the early 80s, that we have had to address both an inflation problem and potentially a growth problem at the same time. That's what we call stagflation. That often leads to recessions. I'm not predicting one, but I wouldn't be shocked if we had one somewhere down the line as a result of all this.
Afsaneh, we spent some time listening to the chair of the Federal Reserve, Jay Powell, saying, we don't think inflation will last. Now he's admitted that wasn't quite right. It's lasted a lot longer. But he kept saying, if it does come, we have the ammunition, we have the tools. Do we have the tools?
We do have the tools, but I think we started a little too slow on starting to increase rates, but also to stop buying securities, which, as we just heard earlier in the program, they're going to start doing also. We're stopping it now, but kind of belatedly. I think everyone has been puzzled why the Fed did not start with that a little sooner. The issue is exactly as Steve was saying, is because now the war and the supply chain problems that were supposed to go away. Remember also, a lot of people in the government were saying that inflation would be halved by the end of this year, right? So whatever, if we're at 7.5, it would be close to 3 to 4%. Obviously, that scenario is not very likely today. And to increase rates enough to deal with that level of inflation, if God forbid we got to 2-digit inflation, would be very difficult for the Fed.
Steve, I want to come back to something you just said, which is you're not necessarily predicting a recession. At the same time, one of the questions I have, looking for a half full part of the glass, there was a fair amount of strength in the U.S. economy and strength of the consumer and the household balance sheets going into this. How confident are you that we have enough strength going into this that we can weather what is going to be a storm without a doubt?
Yeah, you're certainly absolutely right to point that out, David. There's still an enormous amount of what I'll call excess savings or savings above normal levels on household balance sheets, going all the way back to the stimulus checks and the amount of relief that was put into Americans' bank accounts, as well as the fact that they did underspend during the heat of the pandemic. So there is definitely a cushion there, which is why I wouldn't suggest there's a recession that's going to happen imminently. But that doesn't necessarily obviate or eliminate the possibility of a recession. It just postpones the possibility of a recession. At the end of the day, people are at the moment having negative real incomes. Their incomes are going up slower than inflation. So to the extent they want to maintain their lifestyles, they have to dip into those savings. Those savings are being eroded by inflation. And as I said, I think it's simply a postponement of what might, and I underscore might, I'm not predicting it, but it's definitely something that we should have on our radar screens, almost certainly not for this year, but potentially for next year.
Afsaneh, last one to you. On your radar screen, the possibility of a recession, and how likely is it?
I think given the huge force of the growth that we've got behind us, I don't see recession. I am hoping that that as we start getting some of the supply chains a little bit under control, the part that was caused by COVID versus the war, I think that will have a positive impact. The big thing that is concerning me, David, is the fact that we saw low wages go up, but now with inflation, the impact, as Steve was saying, is much less. And that could slow down consumption and slow down this growth. But I think for the rest of this year, we have a lot of momentum that will, at least in the US, if not in Europe, which is a very different kind of situation where you might get recession, get us through. And that's why this is probably the haven for investors.
Yeah, it certainly looks like we're going to need a lot of that momentum. Thank you so much to Steve Rattner of Willett Advisors. Thanks for being with us, Steve. Afsaneh Beschloss is going to be staying with us as we turn our attention to the markets this week and what they are trying to tell us. That's next on Wall Street Week on Bloomberg. This is Bloomberg Wall Street Week. I'm David Weston. Markets reacted throughout the week to the dramatic effects in Ukraine and to the reactions of governments and companies around the world. And for the most part, everything was for sale, with the S&P 500 down 2% on the week and the Nasdaq off 3.5%, while the yield on the 10-year climbed from under 1.7% up to just over under 2% by the end of the week. And even oil sold off this week, with Brent crude falling from its peak of $130 a barrel to end the week just over $110 a barrel. Afsaneh Beschloss of RockCreek has stayed with us to help us understand the market actions. So first of all, let's talk about geography for a moment, Afsaneh. There was sort of, I think, a bid on European equities. Has that come off?
Yeah, I think what we saw is in the middle of the week, people thought that European markets had overcorrected, and then that sort of stopped towards the end of this week. I think that coming into the next week or two, Europe will continue to be under pressure, and depending on how long this war takes and how much longer energy prices in Europe, which are almost like a multiple of what we're paying here, will continue. If we're paying for natural gas in the US for a couple of dollars per MMBTU, the Europeans are paying like 10 times that. So just imagine the price of the components as well as for consumers and how that will impact consumers there.
Afsaneh, talk to us a little bit, I'll call it the plumbing of the system, essentially. MSCI took out Russia, and we saw ETFs that were in Russian stock. They can't trade them anymore, which has really wreaked havoc with that. And how's China doing?
So the super interesting thing that has happened is, David, if you go back historically, 2006, China and Russia had almost the same weight. There was at one point where they were both 10% of MSCI. Then just before the war, I think Russia was about 2.7, just under 3% of MSCI. Of course, as of this week, the share went to zero because it got taken out of MSCI. So here you are with China being in excess of 30%, and if you add Hong Kong, in excess of 40%, and if you include China, Hong Kong, and Taiwan, not as as one block, but as sort of an area of Northern Asia, that's a huge block of emerging markets. And you have Russia at zero. Somebody at some point, when they do the report card, Mr. Putin has to say what happened on your watch, in your country, and with the markets and the companies in your country. So that is really, really interesting. The other thing that happened over the last couple of weeks is because commodity prices went up, the share probably of a number of Latin America countries that had gone down a lot in MSCI has probably started to get adjusted to higher levels.
Afsaneh, what about tech? I mean, RockCreek had their note out at the end of this week, and then you had some, what I found to be stunning numbers about the NASDAQ.
So while everybody is aware that NASDAQ was down more than 20%, huge numbers of companies, more than 40%, were down. The share of companies in NASDAQ, particularly the smaller companies, that was down was huge. And there were like about 20% of NASDAQ was down by more than 3/4. So that is a huge, huge hit to many companies. And I think that will continue, where there will be bifurcation among the better companies with better value, with better ability to generate income versus the ones who sort of benefited from the last 5, 6, 7 years momentum in the markets.
There's so much uncertainty. I know it's impossible to know what will continue or for how long, but two things. One is the move to U.S. from other alternatives like Europe, but other EM investments, but also the move to value versus growth or tech. Do you expect that to continue for a while, or is it getting close to the point where you so-called buy the dip?
I think the move towards value has really just started. I think you're not going to have the U.S. government put another set of many trillions into the market. So you're not going to have what happened, post 2008 and post 2020 happen. It's going to be the market trying to work in a very different environment with higher inflation. So I think the kind of returns that we've seen over the last 10 years are sort of behind us. You're going to have more obvious kinds of returns for the companies that deserve to benefit from growth and who are doing well. And that is, David, I think, a move towards active versus passive management that will be a big change in the markets coming forward.
quickly here at the end, I'm going to put you on the spot. I don't know the answer to this question. I know that you at RockCreek have a portfolio you run against other portfolios based on ESG, environmental, social, and governance. I know in the past it has done better. Is it holding up in this kind of chaotic marketplace?
So the really interesting thing is everyone is looking at oil prices, but also if you look at the value of the ETFs, even not active stocks or private companies, for energy, solar, wind, or uranium, which is sort of looking at indirectly at nuclear energy, those have gone up quite a bit too, between 10% and 20% over the last couple of weeks as the war started. So I wouldn't say that they've done as well as wheat or as nickel or as oil, but certainly have done well. And looking forward, I think we'll be the beneficiaries of what's happening, not just in the US, but of course in Europe, as we've seen what the ECB said and what the Europeans have said about moving much faster into renewables to become self-sufficient and to build out their energy security.
It's fascinating. Really appreciate your being here. We've been following this with Afsaneh Beschloss through the months with RockCreek and what they've done on the ESG, how this war really might affect the shift towards alternative energy. Really great to have you with us. That's Afsaneh Beschloss. As I say, she's the founder and the CEO of RockCreek. Coming up, we look at the week ahead in markets around the world. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. It's time to take a look at next week on Global Wall Street, starting with Juliet Sally in Singapore.
Thanks, David. Central banks in Japan, Indonesia and Taiwan hold rate meetings this week in the wake of the Fed and amidst energy prices surging on the war in Ukraine. On that note, there's fresh inflation data due from India and Japan, as well as minutes from the latest Bank of Korea and RBA meetings. And we'll also get the latest Chinese data dump showing the extent of the slowdown in the world's second biggest economy. Now over to Danny Berger in London. Danny?
Thanks, Juliet. In Europe this coming week, there's really only one story, and that is the war in Ukraine. Of utmost importance is the humanitarian crisis as the war goes into another week with more casualties and more Ukrainians attempting to flee the country to seek refuge. Now, beyond that, we're going to pay close attention to any talks between Russia and Ukraine, as well as the second order effects on the economy as oil and energy prices move higher, raw material prices move higher, the inflation that causes, and of course throughout Europe, the cost of living impact that will have. Now over to Romain Bostic in New York.
Thanks, Danny. The Federal Reserve here in the U.S. is widely expected to raise its benchmark interest rate for the first time since 2018. Market expectations are for a lift of 25 basis points, but the big question lingering out there right now is whether the recent surge in energy prices has deepened inflation enough to warrant a more aggressive monetary policy response. Fed Chair Jerome Powell, though, has said that Russia's invasion of Ukraine means the Fed will have to, quote, move carefully. Meanwhile, top Democrats and Republicans in Congress are vowing to next week push forward with a proposal to suspend Russia's preferential trade relations with the U.S. and clear the way for tariff increases. Those increases could be material for some investors. David?
Thanks to Juliet Sally, Danny Berger, and Romain Bostic. Coming up, what the war in Ukraine means for investors with Sam Zell of Equity Group Investors.
I think there are places that are uninvestable that were investable a month ago.
This is Wall Street Week on Bloomberg.
What is happening is a genocide of Ukrainians.
War is hell. We heard that first from American Civil War General William Tecumseh Sherman. And hell is a good description for much of what we are seeing in Ukraine, as Russian forces press their attack, destroying homes and families in their wake, and in the process wreak havoc far beyond the borders of Ukraine itself. The United States and its allies have imposed sanctions on Russia that President Biden says are crippling.
We are enforcing the most significant package of economic sanctions in history, and it's causing significant damage to Russia's economy. It has caused Russian economy to, frankly, crater.
Oil prices have gone through the roof.
Oh my God. It's $100 and it's not even a full tank.
I think that's crazy.
When you get to the kinds of prices that we're dealing with today, the 120, 130 barrels a day, you're starting to encroach upon that area where demand destruction will start to occur.
And Western companies are stampeding their way out of Russia, from American Express to KPMG to McDonald's and many more.
Goldman exits Russia. The bank becomes the first major Wall Street player to announce it's pulling out of the country as its war with Ukraine rages on.
Raising the question whether we're seeing a temporary setback for those who've invested in Russia, or whether it is something more permanent.
The longer this goes on, it's going to hit investor sentiment. It's obviously going to hit inflation for the longer term instead of maybe the spike that we were expecting. It's going to affect currencies.
When we need investment advice, we turn to Sam Zell, the famed investor who is the chairman and founder of Equity Group Investments. Sam, welcome to Wall Street Week. Great to have you here.
Thank you.
We
Glad to
have
be
this
here.
crisis in Europe, a true crisis, a war going on in Europe. First and foremost, of course, it's about the Ukrainian people, what they're going through, even as we speak. But it also has ramifications for investors. What do you see right now as ramifications? Are there some sectors that are uninvestable today that weren't a month ago?
Well, I think, first of all, the answer is I think there are places that are uninvestable that were investable a month ago. But I also think that for an investor, this is a level of uncertainty that we haven't had to deal with. And, if you're an investor today and you were investing in Russia, how do you feel about your investments in China? How do you feel about your investments in other places in the world that have not responded to the Ukraine invasion the way we would have expected? So I think that, if anything, as an investor, I think you stay closer to home. And I don't think you become as involved or a believer in globalization as you might have, 6 months ago.
Are there some things that are more attractive today than were before? I mean, for example, gold. Where are you on gold these days?
Well, I said that I had bought some gold for the first time in my life. I historically viewed gold as non-income producing base metal, but I think that the way in which fiat currencies have been, extended and printed, the more I get concerned about whether or not, we're going to see weakness in the value of the dollar or even loss of its reserve stature. So I bought some gold, and I think that, some gold ought to be a part of every investor's balance. But haven't turned into a gold bug or believe that it ought to be a big chunk of anybody's portfolio.
So what about energy? You've been involved in energy through the years. Energy is very much in the center right now, given what's going on with, for example, the ban for U.S. on Russian oil imports, the price of oil, for goodness sakes. Who would have thought? Where are you on energy investments right now?
Well, I've always believed that diversification is your friend. And I've always attempted to have some kind of energy diversification and continue to do so. I think the U.S. government attitude about energy, and the Biden administration in particular, I think is extraordinarily naive. And I think the price of oil is very much a fact that they've sent this message, whether it be blocking pipelines or making permitting impossible to get. Including, banks basically saying, when your revolver comes due, we're not going to renew it because we got to reduce our energy exposure. The transition from fossil fuels to renewables is going to be a very long process, and we're acting as though it's going to be a next week process. And I think that's very dangerous, and I think it's going to lead to overpriced fossil fuel when there is no choice as to its need.
There are reports this week that the Biden administration may be rethinking some of what they've said and done when it comes to fossil fuels and are reaching out even to the oil industry. Is that feasible to turn around, at least to some extent, on that issue? As an investor, can you go back into, for example, shale oil and really reinvest in that? Or are you too nervous about whether they'll stick to their new policy?
You know, first of all, I don't believe there is a new policy. Second of all, and then, you know, at the same time that Biden was prohibiting, you know, import of Russian oil, he was doubling down on, you know, renewables and blocking pipelines, et cetera. So whether or not the administration has given thought to that, it certainly doesn't appear to be the case. And even if it did make a statement to that, I wonder as an investor how much I would trust it and how much in the way of guarantees I would demand before I would allocate more capital into fossil fuels.
So for you right now, as you look at it, given what you know, going back into shale in a big way is not a particularly attractive alternative.
Yeah, we have shale investments today.
Yeah.
We continue to have them. We're not eliminating them, but the natural expansion that would come with rising prices has also not occurred because the administration is so negative and so discouraging.
What about other alternatives for the administration in trying to do something about the price of crude, but also natural gas? For example, Saudi Arabia. Saudi Arabia could increase their output substantially. They seem to be reluctant to do that. Venezuela, you know, the forbidden Venezuela, maybe you could get that back on, and even Iran.
But do you want to do all of that while you're inhibiting made in America fossil fuels? That just doesn't make any sense. What is Venezuela going to do with the resources that are going to come from releasing sanctions? They're not going to be friendly to the United States. That doesn't make sense. I mean, the whole idea of the administration being focused on getting the Iran population back in the world while they're propagating, you know, all kinds of stuff, you know, all over the Middle East just doesn't make any sense, giving them the resources to do that. Last time we did that, the first thing they did was they financed Hezbollah and various other terrorist groups. So that, you know, we got to be supporting domestic policy. We got to be supporting domestic fossil fuels. We ought to be realistic about the fact that a transition will occur, but it's not going to occur because somebody in Congress or somebody in the White House thinks tomorrow would be a good idea. It's got to occur based on a pragmatic assessment of how long it will take and what level of upheaval it will cause.
Sam, we started this conversation with you saying there's a lot of uncertainty given what's going on in Ukraine, what's going on in Europe. As an investor, how do you deal with this sort of geopolitical uncertainty? Do you, on the one hand, say, I don't know what's going to happen, so I just have to get more conservative, draw my horses in, maybe go into cash, for example? Or do you try to game it out and think it could go this way, it could go that way, and this is the way I should put my bets?
I can't speak for any other investor. I can only speak for myself. And the result for myself is added liquidity, not gaming it, because in effect we've proven beyond a reasonable doubt that as prognosticators of what Putin may or may not do is almost impossible to assess. And certainly we've been wrong over and over again. So I think diversification, liquidity, patience, are really the governing factors in terms of how we might respond to the uncertainties that this current environment is creating.
Sam, it's so great to have you here on Wall Street Week. Thank you so much. That's Sam Zell. He is the founder and chairman of Equity Group Investments. Coming up, special contributor Larry Summers wraps up a difficult week on Global Wall Street. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston, and we're joined once again this week by our special contributor, Larry Summers of Harvard. So, Larry, a lot happened this week, a lot of it having to do with Ukraine, but we also got CPI numbers that came in where they were projected to come in, but they were the highest in 40 years, 7.9% year over year. What do you make of those numbers? And by the way, let me ask you the unfair question. When is this going to peak?
Look, these numbers were not a surprise. And by the way, while inflation was 7.9% over the last year, if you annualize the monthly figure, it was close to 10%. So we're not seeing deceleration yet. And given what's happened in commodity markets, I don't think we're going to see deceleration for several months. This is a grave problem. The president was wrong to blame this month's number on Ukraine. Everybody had been expecting from the time before Putin launched the invasion that inflation was going to accelerate from January to February. This is a consequence fundamentally of an overheated economy, and we're not going to have a full solution until we do something about that overheated economy. That's just the fact of the situation. Buying America will make this worse because it will mean higher prices. Blaming corporate greed will chill business confidence, will reduce investment in expanding capacity, and will likely make this worse. We need to simply operate the tools of macroeconomic policy in responsible ways.
So, Larry, you say that buying America will make it worse. Will not buying Russia also make it worse? Because we also had that oil ban imposed by the president.
Look, I think that it probably will raise the prices of gasoline for some interval. It'll raise the prices of heating oil for some interval. But look, this is the price of freedom. The question of our times is, what is the future of democracy, market-based, freedom-respecting systems like our own? And we can't have them endure if tyrants can invade neighbors with impunity. And so if higher prices of gasoline are the price of freedom, it is a price that this generation of Americans should pay. And frankly, it's a small price compared to the price that's being paid in Ukraine or the price that past generations of Americans have paid.
Larry, this week we had more sanctions, and we also had, of course, those CPI numbers. Next week, we have the Federal Reserve. Given the alarming rate of inflation as you describe it, what would you have the Federal Reserve do?
Look, I think the Fed needs to begin tightening. The Fed needs to signal that it's going to do what's necessary to contain inflation. It needs to make contact once again with traditional Federal Reserve concepts like the neutral rate of interest compared to the actual real rate of interest. It needs to acknowledge what has happened with respect to monetary aggregates, though those are anything but conclusive. And it needs to portray itself as troubled by how egregiously it misestimated the inflation problem through all of last year. And it needs to tell us what it's doing to learn from that experience. It needs to tell us what its process is for changing frameworks away from a framework that led it into disastrous error. This is not a time for an insouciant central bank.
Larry, this is a time in Washington that is different from any other, in recent history at least. There's been a lot of back and forth over some things that people might think are even silly debates. Are we moving toward a more serious Washington?
I hope so. I think it's a time for what I like to call a new seriousness. It's a seriousness made necessary by the gravity of the threats we are now seeing, especially with the potentially emerging axis between China and Russia. Whether the issue is coming together to maintain America's technological leadership, whether it is recognizing that the quality of our education system is central to the kind of leadership that we have been able to provide in the world. Whether the seriousness is over repairing our infrastructure. You know, it was a national security concern that drove Dwight Eisenhower to the interstate highway system. It was concerns about the power of the American example that drove the Civil Rights Act in important respects. We need to move beyond partisan bickering and move beyond excuse mongering to ask about the fundamental systems of the economy and how they can be made to work better. And that means both and thinking rather than either or thinking. Democrats are right that we need to be heavily invested in renewables. Republicans are right that we need pipelines for energy security and for the capacity to help Europe be energy secure. Democrats are right that we need more resources infused into education. Republicans are right that we need higher standards and more competition in our education system. Democrats are right that we need more resources put into infrastructure. Republicans are right that we need those infrastructure investments made with much more rapidity and much more efficiency in procurement. Democrats are right that we need to monitor and make sure that businesses are operating in profitable ways. Republicans are right that business confidence and cooperation with business is important. We have common adversaries in China and in Russia where we need to stand up. We have adversaries at home in extremism and radical populists who want to tear down a system that has made this the greatest nation in the history of the world. And we need to come together. It's not about doing hits on TV. It's not about doing an event for a constituency. This is a moment of major challenge that deserves major response from our nation's leadership.
And finally, Larry, when you were Secretary of Treasury, you presided over sanctions regimes. We have seen, I think this week, the unveiling of something that history's never seen. That is the extent of these sanctions being imposed on Russia, how deeply they go, also how many countries are joining together on this. What are we learning about sanctions? And not only from the government, but also what is now being called self-sanctions, where some companies are saying, even if I'm not required to forego dealing with Russia, I'm not going to go in and deal with them.
David, they can work. They can, and I think they are, doing enormous damage to the Russian economy. I think we need to think carefully about just how we administer them. If we require people to sell too fast and to divest too fast, we're going to let bad guys buy things for a song, whether those things are debt securities or whether those things are corporate assets. So I think we need to be thoughtful about how we administer this, but I think this has been a substantial achievement, and it's positive. I've also been gratified to see the way companies have stepped up and recognized their moral obligations. I think it's another sign of what I think I underestimated at first, which is the change in the norms in our system towards expecting corporations to be attentive to stakeholders as well as shareholders, and the common interest in our country in security is one of those important stakes that companies have to respect.
Larry, it's always a great privilege to have you with us. Thank you so much. That's our special contributor on Wall Street Week. He's Larry Summers of Harvard.
I could not be more excited about the future of our game.
Coming up, play ball. And boy, do we need it. That's next on Wall Street Week on Bloomberg. Finally, one more thought. Saved in the nick of time. Let's face it, the news has been pretty grim the last 2 weeks.
A hospital was bombed in Mariupol.
We are now 3 weeks into this war, and the needs of these people are very acute indeed.
Talks between Ukraine and Russia have failed to make progress. Moscow says it's open to serious talks, but Kyiv is warning that Russia is continuing to with the invasion until its goals are met.
As horrifying scenes from Ukraine replaced news of inflation and political infighting and climate change. So we might just be forgiven if we find ourselves yearning for something to take our mind off of all those problems and crises, which is exactly why many of us turn to sports. This week, we had headlines from both football and baseball to help us out on that, even though, let's be frank, it's off-season for both of them. In football, consider the odd case of Calvin Ridley, star wide receiver for the Atlanta Falcons. It appears that while Mr. Ridley was sitting the bench with a non-football injury, he decided to bet on the game. And as Pete Rose could have told him, gambling on your own sport is a no-no. So, as of now, Mr. Ridley will be suspended for all of next season without pay, meaning that he will lose $11 million for a $1,500 wager. You talk about a bad bet. But then there's the case of baseball. After 99 days of impasse and Commissioner Rob Manfred canceling opening day,
we're not going to be able to play the first 2 series of the regular season, and those games are officially canceled.
On Thursday, we got the happy news that the owners and the players had come to terms, giving the players more money and all of us the 162-game season that we truly need.
I could not be more excited about the future of our game. I think we have an opportunity in front of us. I think it's an opportunity that we need to work with the players to fully seize.
So with all that seems wrong in the world right now, at least it looks like we will get to go out to the old ball game after all. That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.